Good morning, ladies and gentlemen. Still nothing to see from the risk dial. It is now in danger of actually moving back to risk on. So just as well as that we ignored this brief episode, I think that even if it does move into risk on, it's still very much in danger of moving back to risk off. So this is one of those strange periods when it really is not going to be any help to us, because very small changes in the score are mathematically going to cause risk on and risk off. It's only logic that's going to help us now, and I will try to go through this logic of what the central banks are going to do or are trying to do, and compare that to the level of R star and what the yield curve in the bonds is likely to do. Last week, really, we saw very small movements. The yield curve steepened. The short end was off 5-6 basis points, while the long end was up 6-7 basis points. So every time we get to this 4.99, 5%, the market just can't get through in the twos. And this will be the situation, I think, for the next few days in the US until the FOMC. And why is the ECB going to cut rates? I mean, it would be really a complete shocker if the ECB did not cut rates, because they've telegraphed it so well. They want to start to normalize their curve, and I think the Fed wants to do the same. It is unsustainable for this curve to remain inverted forever, especially in the US, because they have so much stuff to sell, and the only way that I can see that they can get the enormous amount of duration they have on offer away is to get the leverage players to buy it, and buy it with a positive yield curve so they have positive carry. At the moment, it's going to be very, very difficult for them to do that going forward, because the amount of auctions, as you saw this week, every time an auction comes in, doesn't really go brilliantly. What can we say about this? We can say that we are in a period of waiting to see what the Fed's dot plots are going to be, and in a period of seeing how hawkish a cut the ECB does on Thursday. So let's have a look at what is likely to happen. I still think that every time it gets to this 5.05 area, the twos are going to find it absolutely rock solid, because if you do the mathematics, unless you think the Fed is going to tighten, and I think the odds of that are very, very low, because we're not getting a reacceleration of inflation, and we can only get that when really oil starts going up to 85, 90, 95 bucks, and it's just not doing that, and we'll have a look at that later. But unless that happens, I think the twos around this 5% are a great buy, because the odds revert to mean reversion, and that is somewhere in the lower part of this tiny corridor between 5% and 475. So it all matters if we are pricing in just about no cuts, and then pricing in 1 to 2 cuts. And that is all that is happening in the short end. What is the longer end pricing? Well, they're pricing in the terminal rate. It seems that the market is slowly coming to the realization that the cutting cycle is going to be nowhere as aggressive as they thought it would be whenever it starts. We don't know when it's going to start, but we can estimate by the way the economy is evolving, and how the employment situation is evolving, and how the inflation situation is evolving, that the likelihood is that R star is higher. That means that even if inflation, which at the moment is sticky, moves down towards the 2% that the Fed has as the target, the likelihood is that the terminal rate of Fed funds is not much higher than 3.75 to 4%. Why would you constantly be buying duration when, if the curve normalizes, where are fives going to be? Well, they're not going to be a million miles away from this 450 area that they are in at the moment. Where are the tens going to be? Well, they're not going to be a million miles from 450. Where are the 30s going to be? Well, they're not going to be a million miles from 465. So what the market is actually saying here is that we are in a period of very tight ranges at the longer end, because they're not going to get the data that tells them that things are going to be a million miles different from what we are pricing in at the moment. It's very, very unlikely that NFP next week comes in particularly weak. Why? Because we've had all the data that is the component to it, and that is showing that the employment situation is stabilizing. What could change is that JOLTS shows a big decrease in available work, and that could make the curve look for more cuts and a lower terminal rate. But it's going to be very, very marginal. So if that happens, I really don't see that we can really go any lower than this area. And I think that volatility in bonds, the MOVE index, is pricing things very well. It's basically telling us that we are at the lower end of our ranges, and the likelihood to me is always going to be one where we break down towards the 70s and say that we are basically going nowhere, because we don't know when the Fed is going to start cutting. I know that they've said they would start cutting, or they would like to start cutting, but we don't know if the data will allow them. The longer the data doesn't allow them to cut, the longer probably it means that the terminal rate, whenever it is achieved, is actually going to be higher than they now think that it will be. And the cutting cycle is going to be shallow. Having said all that, we still need to make money day to day, because that is what we do. How are we going to make money day to day? Well, really by avoiding mistakes. And in a period like this, unless you get some amazing piece of data which says that the market should be trending one way or another, it is a mistake in any instrument to try and force the Bollinger Bands. So that is the best piece of wisdom I have for you. However bearish or bullish you might be, you do not trade counter to what the Bollinger Bands say. And I think I've been clear as to why. It is simply because there is no impulsion in this market to the upside, because we all are looking for when the Fed is going to start cutting, just like the ECB next week. But we all also know that we have the extreme likelihood that R star is constantly moving higher, and therefore that the terminal rate is going to be probably somewhere in this region. So even if the Fed cuts 2 or 3 times over the course of the next 9 months, data allowing, the likelihood is that the net move in the long end is going to be very, very low. Therefore, if you see the 430s, why would you not get out of any longs? It just doesn't make any sense to try to force the market below this kind of level. As far as the yield curve is concerned, I have not changed my mind. I think any kind of extreme in 2's 10s, 2's 5s, 2's 30s is a sell. 347 down to 328 is the current trading range, but that does not mean that at some stage with any kind of weak data we don't start pushing down towards 16 and then towards 0. This curve has to uninvert at some stage. It just might take longer than we all think, but the likelihood is, to me, as close to, I don't know, 80-90% that at some stage we disinvert for the logic that I've given you. The supply is huge. We have just about 5-10 basis points of term premium. That is not the kind of scenario or situation which enables further flattening. The curve will steepen. It's just a question of when and from what level. It is very unusual to see a curve actually increase in yield into a rate cut. But that is a function of what I've been saying. The market is trying to sniff out what the terminal rate is going to be, and the market is trying to sniff out how aggressively the cuts will come. Lowering by 25 basis points and then telling you that they're not going to lower again until they see that the data is supportive of it means that the 2-year is basically stuck. I would be very surprised if after the cut we were below the 3% area, if that is what they say, and that is what I anticipate that they will say. Also, the 5s, very, very unlikely that they move below this 255, 257 area. And in the 10-year note, I really don't expect very much at all. I think it can just keep on slowly disinverting this curve. If we have a look at, for example, 2's 10s, the slightest bit of bad news in terms of how strong the economy is in the EU, i.e. that the economy is stronger than the extremely weak expectations for it, should make these 2's 10s actually go down towards this 25 area. Why not? It makes perfect sense to me that the disinversion of the curves should happen in both markets. In an environment where you have the ECB only very slowly reducing the rates, it makes sense to look for levels in something like the French market, and this is the 10-year oats. To me, this 325 level is going to be extremely interesting. If there's disappointment from the ECB's action on Thursday and 325 trades, I think that's going to be a very interesting level to actually buy some, and then either spread it against the bunds or just hold them. But it technically it's a very important level. You can see the lows here, you can see the highs here, and every time it tried to go through it, then it collapsed. 324 to 325 to me in the oats is going to be very important, and I certainly think that we should buy some there, especially because I don't see the 10-year in the States going up massively in yield, as I told you, but also because the spreads against the US are coming in a bit too far, and I'll show you those now. Whatever I look at, and this is 2's, and you must admit that it doesn't really make a lot of sense for that to go past these kind of levels, because one central bank is cutting and the other one probably will show only one dot plot on next week, the week after next. To me, if it gets down here on any disappointment of what the ECB says, and I don't see why there should be that much disappointment because they've telegraphed the cut so well, and that it's going to be a hawkish cut when they say that, okay, one, and now we wait for a good while. If that is the situation, I think it makes perfect sense to now look for the action to be in that spread going higher because of the potential disappointment and probable rather disappointment of what the Fed's dot plots are going to be the week after. And if we look at fives, I think this kind of level is going to be a bit of a gift. And if we look at tens, I think if we start breaking down towards 172, 173, that is going to be a bit of a gift again for 190. Now, what does that actually tell you? It tells you that if we see the OATs or the Italian bonds, which have much less of a negative carry, approach the levels that I showed you, that means that we should go long of them as opposed to do anything in the US or spread it against the US. I really think it's very, very unlikely that we start going through these levels, and therefore I think that being long of OATs at that 24-25 level is logical and technically perfect. I don't have much to say about the dollar. I think the likelihood is actually that it tries the upside on a cut by the ECB and then actually comes down. I am not bullish of the dollar at the moment. I think that these levels around 105.20, 30 are going to be and remain sells. And if we look at the euro against the dollar, I think anything here in the 107s is going to be a buy, and I think the market will retest this 109.92 area. Probably it's a sell up here, but I think there is going to be a lot of stops up here, which might take it even towards the 110, 110.20 area, and that should be the level that matches with the Bund and the OAT and the Italian BTP reaching its highest levels and then returning back down. So that matches what I'm looking for. I think if I see the Euro USD up here just above 110, that is going to be pretty toppish, and that's going to tell me that the European rates are about to turn. DBC is just going up and down, and really going nowhere. I cannot get bullish of DBC until it takes out this 2430 area, because that will mean that it's in a new trading range looking to strike this 2550, 2580 area. While it's doing this, I think I cannot get really bearish of bonds, because unless DBC starts going higher, no reacceleration of inflation is likely, and therefore we can't even begin to think of pricing in that the Fed is going to do anything but cut rates at some stage. I know a lot of people have been talking about, the Fed, needs to hike. Well, it certainly does not need to hike at the moment, not unless inflation reaccelerates, and DBC is not giving us any signs that it is accelerating. I mean, if we look at it, we've been here since what? May of last year, so 12 months of net zero move in commodities. Where is this reacceleration of inflation going to come from? Gold absolutely loves to stop people out, And as I've been saying, it just cannot get through this 2375 area and close up there, which to me says that at some stage it actually tests the lower edge and stops everyone out below 2320, which was the previous daily close, as it were. All it needs to do is basically break this level and do some kind of an ABC and go down to 2250.70, and that's going to be a good area to buy it. But I just get the feeling that they are much, much more likely to break down gold for whatever reason than they are to take it straight up. Let's start the equities with my clean chart, and let's try to put in words what happened last week. Last week I told you that this 52, 55, 60 area in SPX was the important area. It held the support for 3 days, and then it basically gapped through and went down. On Friday we tried to take it all the way down to 51.80, and in the last hour we took it back above 52.54. That to me says that any kind of retracement to 52.54 next week in the early part is going to get bought, and we're going to fill this gap up to 53.05 or whatever it is, but we're going to probably turn back down from it. It's going to be very quiet and very boring. Now, why should that be? A, because volatility is low, but B, why are people selling equities? If I'm correct and the bond market is going to remain in a very narrow range, and then we are going to have the MOVE index probably moving down into the 70s, that is all supportive of equities, just because I think equities as a balance sheet are in much better shape than the US government's balance sheet. Why would you not lend money to, Apple at a higher interest rate than the government? I just don't see why that would be. If those credit spreads remain narrow, I can't see why anybody would sell equities aggressively. All the support levels, and there are so many on the way down, are going to hold for a bit and cause reactions. In no way can you expect big moves down in equities. It just doesn't make any sense at all to me, and therefore I think every time the market is outside of something like, and let's turn to this chart and enlarge it, every time we are outside of the Bollinger Bands on the downside, like we were in the last hour of Friday, the likelihood is that technical conditions force the squeeze. Now, was the squeeze huge? Yes. Was it silly? Yes. But what the market is showing you is that selling through the Bollinger Bands or buying above in either bonds or equities really at the moment makes no sense, because technically we are in a sideways period with equities still being preferred to bonds. So I really can't see us not taking advantage of opportunities to buy when technically we have them. It's a technical market now until the Fed gives us guidance with the new dot plots, and I think it remains a technical market even after that, because the Fed's not going to tell us they're going to start hiking. The Fed's not going to tell us that they're going to start easing immediately. The Fed is going to tell us that they are basically in a watch and see period, but that they would like to cut. And that is not the kind of environment which makes equities collapse. Exactly the same thing that happened to SPX happened to NDX. I mean, exactly the same. NDX achieved a level that I told you exactly down here at 18,200, and then it just bounced like crazy. Every time we're outside of the Bollinger Bands, this is going to happen. Why was NDX under pressure all week? Well, very simple reason, and that is these Bollinger Bands that we have here on the weeklies. And if I enlarge these Bollinger Bands on the weeklies, you will see that next week we're still going to be bounded by these kind of levels around 18,800. What are we likely to do? We are likely to squeeze people all the way into the gap and then come back down and retest at least this level, which is 18,450. That is the likelihood that we are going to be within that range all of next week. It's a technical market, and I think that any kind of dips towards these moving averages on the weeklies are going to get bought, and bought hard. It's a new month, and therefore always worthwhile looking at the monthly charts. SPX closed at a new monthly high. The Bollinger Bands are going to be very close, so I don't think that the market next month is going to go up more than 1 or 2%. If we look on the NQ though, that has a lot more room to run. That is a completely different chart, and that tells me that still NQ or the Magnificent Seven or whatever technology in general is the one that is going to propel the markets higher if they're going to go significantly higher. I don't think they're going to go significantly higher, but I would still much prefer to be concentrated in US equities in technology than not. I really don't see that the other markets are impulsive. I'll look at them now, but they are nowhere near as impulsive as the US. Stocks, not impulsive, right? Consolidation before another move higher. Will it make new lows? Probably it might do, just to piss people off. But it's not the kind of chart that tells you that we have any kind of sustained weakness. And if you don't have sustained weakness in Europe, I think it's extremely unlikely that you have sustained weakness in the US. So this is all you're seeing. You're basically seeing that this kind of area around the 4,900 to 4,930 is a buy area, and really it can't sustain itself above the mid 5,000s for the time being, and it's just going sideways. You can see on the monthly where we are. We closed, the highest month was actually 2 months ago, and since then we've really been consolidating and going sideways. Much the same as the Nikkei, which is really not impulsive either. We are doing some kind of an ABC possibly, and the real shocker would be if it started breaking these levels and caught 36,000, but then it catches the 200-day moving average, and I think the next move is higher. So in any equity market that I look at, whether it be emerging markets, which had a dreadful week last week, really, but all they're doing is they're correcting very overbought situations. To me, any kind of move back towards this 39.90 and I reload. I've been telling you for a couple of weeks, emerging markets, don't bother. So the Nikkei, I would love to see do an ABC down. That would catch a lot of people out, but that would give us a great entry opportunity around the beginning of 2024. When you think about it, it's very unlikely that the Nikkei closes down on the year. To me, these levels, 35.5, 36.5, really is great value for the Nikkei. And the only thing that would make it not be great value is some kind of geopolitical strife. And, what are the odds of that? Well, if you just can't anticipate that. You've got to go in on Nikkei around these levels, and whatever happens, you have a stop, and that's it. So unless these markets start showing any kind of more weakness than an ABC, I really don't see how the US is going to show much more weakness that I've shown you. And every time it goes down, you saw I buy some call spreads. Sometimes it works, sometimes it doesn't work all that well, but overall, it's certainly profitable. There's absolutely nothing in the VIX chart which suggests anything but range trading. Unless we start establishing days and days over this 14.5 area, I think that we're just going to get a repeat of what we've been given so far, which is 2-3 days of weakness and then a retracement of that weakness in a very short period of time. I think there are still plenty of buyers of equities below the below current levels. Now, why would that be? Well, let's try to logically put together everything I've said. If the bond markets are trying to sniff out that we are going to have a higher terminal rate for Fed funds from an easing cycle, both in the ECB and from the Fed, why would we have that higher level of terminal rate? Well, it can be because of a combination of things, but it's most likely to be A, because the economies remain strong, and B, because inflation, while not reaccelerating, remains a problem. Not so much a problem that it's accelerating, as I said, but a problem that remains even sticky at 2.5. So if that is the case, and R star is 1.5 to 2%, that tells you that the best you can look for in Fed funds is around the 4% area. And if the best you can look for in Fed funds is 4%, and the best you can look from the ECB is 3%, why would you constantly be buying fixed income at negative carry? And then you have equities, which are a better hedge against inflation, have more pricing power, and are being issued a lot less. In fact, they're being bought back. So unless you're going to have some massive weakness in the economy, the trend is always going to be to buy the dip in the equities, because it's a much safer alternative to bonds. So the high-level takeaway is that I don't think that we are going to be trading through the Bollinger Bands on anything, because the situation is not one of trend. And therefore, OAT's 325 is what I'm looking at on the disappointment of what the ECB does. And that's about it. I just look to trade it rather than position myself. All I'm looking for in this particular time period is to make a few ticks that, keep the lights on, rather than trying to hit it out of the park, because I don't think that that is the situation that we're in, and I don't think that that is what the market is going to allow us to have. Periods of low volatility are like this. As I keep on saying, I think that realized volatility is going to be much higher than implied volatility. Therefore, what happened on Friday is not really that much of a surprise to me. Week on week, what did the XPX do? Almost nothing. But we had intraday volatility, which was very, very profitable to harvest, and that is harvested through call spreads at silly levels and before big numbers. Thank you very much indeed, and tweet you tomorrow.